Kitco Mining special coverage of the Deutsche Goldmesse is brought to you by Dynacor.
Gold's great climb is going higher. This is Paul Harris for Kitco Mining at the Deutsche Goldmesse conference in Frankfurt, Germany. And joining me today to discuss this is Eric Strand, founder and portfolio manager of AuAg Funds. Eric, welcome to Kitco.
Thank you, very nice to be here.
Now, Eric, you gave a very fascinating presentation today, and hopefully we'll get into talking about some of the points you raised there. Before we do, let's take a sort of broad view of what's happening in the gold space. We're 18 weeks into 2024, and it's been a pretty good year so far. The gold price has gone up to just under $2,400 per ounce, currently around 2,300. The gold producers are beginning to show some margin expansion and juicy cash flow, and M&A is picking up. Why have we had such a good start to the year?
Well, I think it's a lot about central banks buying, for sure. I mean, 2022 was a record, 23 was almost the same, and Q1 24 is the highest buying of any Q1, so that's a big buyer out there. And also the feeling, even if we don't have seen the rates coming down, the Fed has been doing some kind of backdoor QE. The monetary base is going up again. And the US are going on with very big deficits. So I think it's a very expensive economy out there. It's not just lower rates, they are coming, but now the market can still see it. And it's not so much about the rates, but the QE and also the Fed, they're not going to do the official QT, or very little of it now. So that's the way I think it is.
At the start of the year, a lot of people were forecasting $2,300 per ounce gold by the end of the year, so we're there well ahead of time. Do you expect that to sort of continue going on, or do you see the market having a bit of a pause and thinking about why we've got so far so fast?
Well, as I said on the presentation, we don't really like outlooks, but we said a 20% for the whole year and 24.75 at the end of the year, and now it looks like not a very big target, and even JP Morgan came out here in March to say 2,500, so I think we can go a lot higher this year. Of course, now we are in the situation, a lot of shorts on the COMEX. They want to get the prices down, and if they can push the prices more down below the 200 days moving average, price will go even more down. So it's a very interesting situation. But in the basics, I think it's going up for the year.
Well, one of the things you talked about in your presentation was the COMEX manipulation, and during your discussion there, you talked about the unrealized losses of 20 billion at the moment. What do you see playing out there?
Well, the shorts, they are playing the game. They want, they're always going shorts when the price goes up, and then they want to buy back the shorts on lower prices. And they've been doing that for a lot of years now, unfortunately. I mean, COMEX has become kind of casino for big banks. I mean, it was made for producers to hedge their production, but the producers, they don't hedge anymore, like farmers or miners should do, or that was the purpose of the COMEX, of the commodity exchange. Now it's a big bank casino, and some players, they put on big short positions, and unfortunately for them, I mean, the prices went up with the central banks buying, with the Asian investors buying a lot, and then they have big unrealized losses. It was up to $20 billion, come down a little bit, now as gold has come off a little bit of the top, and of course they are interested to get the prices lower so they can buy back their shorts. For them, hopefully with a profit, but let's see if it works.
It's interesting you say that the central bank buying is a big factor here. Obviously the central banks, they're not buying for investment reasons, they're buying for other reasons. And the strength of that central bank buying seems to be, derailing the bets that the shorts are making.
Yeah, and of course the central banks we have this situation, the global situation, and the US doing its things with the dollar. I mean, they're weaponizing the dollar, and also the talks about confiscating the Russian assets. We can discuss it, if it's correct or not, but it creates a situation like if China are planning something, will they hold any US assets before they do the thing or whatever? I mean, they will de-invest in the dollar, and they probably rather hold gold. So I think that's a reason for a lot of BRICS countries to hold gold instead of US dollars.
Now, you said that your outlook now for gold was originally sort of $2,475 by the end of the year. You said you probably raised that. And in your presentation today, you said that even if gold went to $3,000 per ounce, that would be cheap. But you went beyond that. You said comparing gold with the combined US debt and US Federal Reserve balance sheet, you put a very good chart up. Said that even at $4,000 per ounce, gold would be cheap. What do you mean by that?
Yeah, we made this very, call it simplified, but still very interesting chart. And because the only time when gold was expensive was the 2011 all-time high, 1921. And now we have seen so much debt creation and balance sheets on the Federal Reserve going up so much during the last 10, 15 years. And that makes a lot of room for gold because, I mean, normally gold doesn't have a price. Gold is gold, and it's the fiat currency that loses value. And of course, the more credits or units of the fiat value you create, the less they are worth. And we are creating a lot of fiat currencies now, so that's the reason for gold to go up, and I think there's a lot of room to go.
Now, a lot of the conversation is about the US Federal Reserve and as and when and if it will pivot and by how much and how quickly. Well, what's your views on that?
Well, we have a very strong view on that they will not lower rates because they have control of inflation, but normally they lower rates because there's a problem in the system, and they're always late. And they want to be late because then they have the reason to lower the rates, because they have to lower the rates because the system is breaking down. And when you see commercial real estate in the US, it's not really, really good. And one day will have so much trouble, so they will have to start to lower rates. So it's not because they want or can lower rates. That's not the reason why they will lower rates, because they will lower rates because they have to lower rates. And that's a big difference between that they having control of inflation. And they will not have, so in one day they have to give up on something, and they have to give up on this, what they like to think is the fight of inflation. I mean, they created inflation with money printing, so now they are fighting their own inflation. And normally I think they will give up on it because no politicians can survive big recessions today, so the whole system needs more money.
There's going to be the political decision aspects rather than perhaps the purely technical aspects.
For sure.
Okay, now the gold price may be riding high and going higher, but most gold equities are not really budging much as yet. Why do you think they're taking a delay or time lag to respond to increasing prices?
Yeah, well, now we have at least started to see, I mean, March and April was really, really good for the miners and our funds. But there is a delay, and I think it's natural. I mean, normally it's always like that. Sometimes the miners go before, or sometimes they are delayed. And I think now we had the costs, with the inflation cost for the miners to mine the gold. And the gold price went up because of the monetary inflation. So they didn't make much more money. But now, I mean, the costs have stabilized for the miners, and gold continues to go up. And actually the profit leverage the margin expansion will be much stronger now because of the higher prices to produce. And I think we will see that effect of the miners, and then they will really run. And I mean, they run fast. We see many periods when in 6, 7, 8 months they run 120%, so it goes fast. So there will be a catching up, and that's actually a good opportunity for investors. So if they miss the gold race, they can still make a lot of money on the miners now.
We are at an investment conference, and you made that pitch earlier on, reminding people that mining stocks will outperform the underlying commodities. And you said that you're looking for some triple-digit gains this year.
Yeah, I hope. But we are really waiting for the year when we have a triple-digit gains. We started our funds 2019, so we have had only double-digit gains some years, and sometimes it was a minus also. But we will get the triple-digit years as well. And actually, after the first 2 months, we were one of the worst funds of all funds. And now we are one of the best funds already after 4 months. So it can be this year. It goes fast. Miners move really fast when they start to move.
What do you think will be the trigger for them to really start moving?
Of course, I think you want to see the results, but you also want the capital rotation. And we start to see the big IT or AI companies. They are still, some are getting some momentum up, but it's also down. It's not so safe anymore. So when the big investors start to take home some profits there, start to sell there, that's a good thing. And we also like to see more ETF buying, I mean, that has been weak, so there's a potential from ETF buying, momentum buying. All things has to come together. But it will take some time, of course, before everybody's coming in. And what is good is it's so under-allocated. I mean, it's not 1% of all the assets, and if it would just go up to 2-3%, I mean, it would be so much money coming into the small sector. So I think that's the potential.
One thing that can stimulate excitement in investors and draw attention to the space is M&A, mergers and acquisition activity, and we've seen an increasing number of deals over the past quarter. As you look at the space, which deals have you liked and which have you been surprised at?
Yeah, I would normally, I mean, I like to be, it's good to have the company that is being sold to another company, get a premium, but basically I'm a bit sad that we get less and less companies. I want to have a lot of companies. I want to have companies to choose from, and it gets less and less, and I don't like that.
But most people we have on complain that there's 1,500, 2,000 companies on the TSX and TSXV in the mining space.
Yeah, it is. But of course, we are a larger fund, so we trade only on the New York Exchange and the TSX. So then there are not so many to choose from. Also, what is important when the M&A, I mean, it's good for the business. The companies they have the cash to do it, so that's a good sign. But we don't mine more gold or silver because it's an acquisition or a merger. I think that would be good for the commodity price. I mean, they don't put money to exploration. And that's hard for the explorers because they don't get bought at this moment. But also there are no more developments, no new gold or new silver coming to the market. And that will actually push the prices for the commodity higher, and that will be good for them, for the big miners. But it doesn't give us more gold or silver in the market.
I think we're approaching an interesting moment in time because with prices going higher and costs sort of stabilizing and margin growth, free cash flow growth, each company is going to be faced with the decision, what do we do with that? The growing cash on our balance sheet? Do we invest in growth in our own portfolios? Do we buy somebody else? Do we turn to shareholders through increasing dividend payments or share buybacks? What do you think the gold company should do with the money they're going to be making?
Well, first of all, I think we have to notice that there has been a big change from the 2011 era when they did too much expansion, too much growth, and they spent too much money. And shareholders were not happy with that, and all owners had to pay for that. Now they are doing the opposite. They are keeping the cash, or they are buying already developing rather big companies, and they have higher dividends, rather high dividends. They are starting doing buybacks. They have lowered the debt, which is, I mean, it's great for the companies. They look good, but of course they don't grow as much. So it's an interesting situation, and they are very unsecure due to geopolitical reasons. To start a new mine, even if you have something there, you start it takes a lot of time, costs a lot of money, and then you don't know the political situation. So I think it will be different this time.
In terms of, I sort of take on your point about the lack of investment going into exploration, and that's obviously going to have long-term ramifications. And somebody pointed out to us the other day that, Barrick Gold, it's not even producing 1 million ounces per quarter. So the size of the prize, if you like, seems to have shrunk over the years. And perhaps part of that is through the lack of investment in exploration and growth.
It is, but of course, I mean, if there's no exploration, no growth, there will be less gold and silver in the market, and the price of gold and silver will go up, and then the big ones, they will make money on that. So I don't know, I think that's the new trend for the moment. One day it will maybe start to change if big one finds some good explorers that really have the gold and silver they think they have. That may change, and the competition between the leaders will be fierce. So I think that can change things over time, but at the moment they are focusing on being share owner friendly to existing share owners, good or bad, but I think that's the play right now.
With increasing money coming into the sector through sort of the cash generation, it would seem that companies have an opportunity to perhaps better diversify or differentiate between them by following different strategies. Do you see that as they're likely to happen? Because they all seem to move as a group into capital conservation and protect the balance sheet mode sort of 10 years ago. Will they diversify and do divergent strategies now?
I mean, I mean, copper has become very popular. So, I mean, a lot of them already mine copper and they look more at copper, maybe. But I mean, it's not so much copper either. It's not enough of it. And what I would like to see, if they don't buy assets, at least put some of your cash in physical gold and silver. Hold to it instead of holding a lot of cash. Because if you believe in your product, I think that would be good, and that would also be good for the price of gold and silver.
Well, rather than buying gold, why don't they just inventory what they're producing and keep it there, add it on their balance sheet and hope for high prices?
Yeah. Don't sell it cheap.
But nobody really seems to do that.
No, and that's the interesting thing that would be really interesting if the mining industry would become more of a price maker and not a price taker. I think that has been a problem for a long time, that miners are price takers. And big companies, successful companies like Apple or so on, they are price makers. They make the price, they put the price on the phone, and we have to buy it, and we do. And I think maybe we somehow get some change in that order.
I mean, that would be interesting and fascinating if that happened. Eric, how do you think the rest of this year is going to play out?
Well, I think it's a lot about, of course, the costs for the interest rates. I mean, things will happen there, and also the political situation and the trust in the US. Unfortunately, when we get into these problems, we start to see more wars, and we have seen that already for a long time now. And that's not a good feeling, because it's a trouble in the financial system, but if we start to see wars and people making money on wars and so on, that's not good. So I really hope that the war situation calms down, and maybe if the US could stop weaponizing the dollar, we get some more trust and more cooperation, getting back to globalization instead of deglobalization. I think that is important. But and the cost, you can see consumers now, I mean, you see it in the US, Starbucks, the consumer products. The consumer is in trouble because they can't pay the interest rates.
I would agree. I think sort of greater stability would be a good thing, but I'm skeptical. I don't think we're going to see that happening, at least not this year.
Unfortunately not.
Well, Eric, it's been a fascinating conversation. Thank you very much for joining us today.
Thank you.
And I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Dynacor.